So I wanted to talk today about more violations of regression modelling assumptions, namely the issue of autocorrelation. So we will see then that this is an extension of the previous week, and again, another theme that's recurring here. The main point is that if the regression modelling assumptions don't hold, then you can still run the regression. You won't blow up your laptop, it's just that you won't necessarily be able to trust the computer generated output, and that will be the big deal here. Okay, so nothing untoward should happen that should cause your laptop to explode. It's just that you may not be able to take any regression generated output at face value. Okay, so it's important, I think, in terms of the theory and just some of the underlying principles. It's important really for MSc dissertation students because this is the sort of thing that you can do in your dissertation, and if you do this, you're beginning to push towards the limit of what you can naturally expect students to do. Okay, so what happens with autocorrelation? The name itself is deliberate, so auto means self, so just as a sort of heads up with what to expect with this, autocorrelation refers to the situation where the residuals from the regression model are correlated with themselves, in contrast to the standard regression modelling assumptions for the classical linear. So in terms of background reading then, so I've recommended here Gujarati and Porter chapter 12, but I've tried as much as possible to get the lecture notes and the lecture materials self-contained, and I'm indeed trying to rework these notes into a textbook myself. So just to sort of point out, you do have quite a lot of resources available to you, although obviously it's not ideal teaching circumstances at the moment. So you've got the PDF lecture slides, these lecture recordings, and the PDF study book. And the study book and the lecture slides are available on the module page on Canvas. Now, past students of mine have been able to just teach themselves from the PDF lecture slides. You've got these extra resources this year, though obviously in-person teaching is more difficult. And really what this subject is about is just making sure that you can trust the computer generated output if you're running a regression model. Okay, so there is limited danger of your laptops exploding at any point. It's just that if the regression modeling assumptions aren't satisfied, in this case if you've got autocorrelated residuals, then you may not be able to take the results of any computer generated model output at face value. In terms of the outline of the lecture then, so talk a little bit about the nature of autocorrelation. This is a very commonly encountered problem for finance and accounting, especially if you've got price data that are recorded over time. Talk about causes of autocorrelation, then we'll talk about some graphical tests for autocorrelation in eViews and R. In contrast to last time, I think this is one of the examples where this is actually easier to do in R than eViews because R is a high level programming language. Talk about some statistical tests for autocorrelation, and again I think this is an instance where R is a high level programming language, is actually easier to do this than in eViews. Then in terms of remedial measures, we'll talk about the first approach, which is probably the best one to recommend. If you fit a regression with autocorrelated errors, this is the most practical approach. You can do this in both R and in eViews, and then there's a sort of method here which is a Newey-West correction, which is practically minded but is only really available in eViews. And I would say here though that these are both probably fitting autocorrelated errors. West correction, careful about the nature of the assumptions that you're prepared to make. So as promised then, this is what the term autocorrelation means. It's deliberately named. The thing tells you what it's really doing because of the name it's got. So auto means self. So by extension then, autocorrelation just means correlated with oneself. So nothing difficult so far, it's just an exercise in puerile English. So if you look at the assumptions of the classical multiple linear regression model that we talked about in the last lecture, this assumes that all the regression error terms are uncorrelated. So it says there in the first equation, the correlation of ui and uj equals 0 whenever I and j are different. However, if you have autocorrelation, then in contrast to the above equation, for some values of I and j, the correlation is non-zero even if I and j are not equal to each other. And then this is the main point, so the laptop is unlikely to explode. If the modelling assumptions break down, you may not be able to trust the computer generated model output. Okay, so the first equation then describes a scenario where the regression residuals are uncorrelated, and if this breaks down for just one different pair of I and j values, you have instead some autocorrelation, just literally correlation with itself. So behind the equation there, then what's really happening here is that autocorrelation occurs whenever you have correlation between observations that are being ordered in time or space. Now, it's very common with accounting and finance data that this is a scenario. For instance, a lot of my work has been collecting price data that are recorded in time. So, for instance, the closing stock price recorded at the end of every trading day. And in this way, because of the nature of how the data is collected, it's natural that you might get autocorrelation in a given data set. So the idea here is just very simply that observations or measurements taken close together in time or space, but here in time, typically take similar values. And it says there autocorrelation is typically associated with time series data. So the natural way that this could happen is if you've got a data set in finance or accounting that's including, for instance, price data for some security, then if you're taking, for instance, the stock price, say at the end of every day or end of every week or end of every month, then it's natural to expect, because of this, you're going to get a certain degree of autocorrelation in your data. Okay, and that's essentially whatever period that you record the data over. So in terms of autocorrelation then, so the classical multiple linear regression model assumes you've got no autocorrelation at all between the disturbances ui. So for the error terms, if ever I is not equal to j, then the idea is, according to the classical model, the correlation would be 0 whenever I equals not j. The model assumes then that errors are not influenced by errors corresponding to other observations. So lest that sounds a little bit obtuse, if you look back to the lecture example we went through previously, where we had the inflation adjusted gold price and the inflation adjusted stock price, so the naive application of these classical linear regression model assumptions would mean that you'd expect errors pertaining to observations, say for 2000 and 2001, to be independent. So this is equivalent to saying the price data for 2000 is going to be completely different, completely uninformative to the price data for 2001. So if you start to think about the underlying financial environment, clearly this is a big assumption, and it would be natural to expect some degree of autocorrelation between, say, observations for the year 2000 and for the year 2001. So this is intended to give you an indication of how autocorrelation can be caused by economic and financial data being collected over time. Happens time and time again whenever you're looking at price data, for instance, in accounting and finance. So the main point here is that if your laptop explodes, you'd be unlucky, but if the regression assumptions are not satisfied, then everything can look nice, your laptop doesn't explode, and you can generate some regression output, but you may not be able to trust that output at face value if these regression modelling assumptions are not satisfied. So some common problems might be then that you underestimate sigma squared, so you underestimate the uncertainty that there is inherent in your sample. You might overestimate R squared. This is a big problem for sets. The usual t-tests and f-tests are no longer valid and may lead to misleading conclusions about statistical significance. Again, you may not be able to trust the model output that the computer gives to you. One other thing to watch for You might necessarily underestimate the residual variance, for instance. The solution to this is to maybe use OLS estimators, so this is the usual regression estimators combined with Newey West. So this does work similar to the white correction that we discussed in eViews in the last lecture, but I suspect the best approach is to include an auto. So there are several causes then of autocorrelation. Typically, the main thing that happens is with accounting and finance data, if you're looking at price data, these are often recorded at the end of every day or every week, etc. And then you get some autocorrelation caused by successive observations being recorded over time. This has been given this sort of rather grand title here of inertia, but this is just if you have price data collected over time, natural to expect there's some correlation between, say, prices on a Monday and a Tuesday, for instance. Stationarity is often a problem as well with economics and finance. Models misspecification. Again, this is a general problem, although you have to go up to remedy this. This is quite a difficult problem. This is a general phenomenon in economics, so you've got to remember that the data that you're collecting pertains to some complex network. So you change one aspect of the network, you completely change the behavior of the system. Networks are inherently complex, as you see at the moment with the current coronavirus, and there could perhaps be some problems with data limitation and manipulation as well. Censored data in some sense. So key cause then of autocorrelation is inertia. So this is very often the case when you have, for instance, accounting and finance data collected over time. For instance, if you're looking at the price of a certain asset and you have the price recorded at the end of every trading day or the end of every trading week, etc. Beyond this, you might see other examples where economic time series tend to exhibit cyclical behavior. If you've got data that are recorded over a number of years, cycles which tend to affect things like gross national product, price indices, production figures. This tends to be quite low frequency macroeconomic data. Like to see would be higher frequency data, perhaps of the order of days, weeks or months, where you're looking at the price of financial assets that are recorded at set time intervals. Whichever example you see, the effect of inertia is that successive observations are going to be correlated. This is an extremely common phenomenon in financial and economic time series, affects all sorts of problems within accounting and finance, and we will see in this lecture that this has some particular relevance to the example we discussed earlier, where we're looking at the inflation adjusted gold price and the inflation adjusted stock price. So another cause of autocorrelation is non-stationarity. This is a particular problem if you're looking at data over a number of different years, or if there's something weird going on in the data set in question. For instance, if you're looking at, say, financial price data and you've got something like a big speculative bubble, or there's a stock market crash that happens halfway through the data set. So the basic idea is that if you've got non-stationarity, because all sorts of business cycles and short-term phenomena like bubbles are going on in the background of your data set, then the variables in question may be non-stationary, so it's natural to expect that any regression residuals would inherit this non-stationarity from the variables in the question. If the error variable is then non-stationary, then it's natural to see that the error term will exhibit autocorrelations, and this is again a common problem in finance and economics. And I guess really the main take-home message of this is that autocorrelation is a problem whenever you have observations recorded over time, which is especially true for accounting and financial data that often rely on the prices of a given asset recorded at the end of every trading day, or the end of every trading week, etc.